Hello, everyone. I'm David Darst. I'm speaking with you today from Zurich, Switzerland, and I hope you're having a good continuation of May. Last week in the U.S. equity markets, it was a difficult time for stock prices. The Dow Jones Industrials were down for the eighth consecutive week. That's the first time that's happened since 1932. The Standard & Poor's 500 were down. The 500 stocks in that index were down for 7 weeks in a row. The bearish sentiment right now is quite rampant, quite strong. You had over 50% bearish in the American Association of Individual Investors survey, which I've mentioned on this call and this video before. This is the first time since 1990, so that would be 32 years since you've had 9 weeks in a row where the bearish sentiment is above 50%. This week it is 50%. The last time it was 9 weeks in a row above 50% was the August of 1990 when Saddam Hussein invaded Kuwait. Part of the reason was for last week's stock price weakness. Number one, Fed Chair Jay Powell mentioned that the Federal Reserve is going to likely continue to have to be quite resolved and resolute and quite firm in continuing to raise interest rates. As you know, on June 1st, we begin with the Treasury securities and mortgage-backed securities portfolio reduction of the Fed. So that's a form of quantitative tightening. And of course, you have the verbal back and forth of Fed governors and regional bank Fed presidents. Some saying we need 50 basis points, sometimes 75. But right now, the consensus seems to be 50 basis points. Wednesday of this coming week will be the release of the minutes from the May 3rd, 4th FOMC meeting. People will be looking through that to see the extent of the debate and the discussion. The second reason for the weakness last week was the decline in earnings results and guidance for Walmart and of course for the huge big decline in Target. Target fell 29% last week. Walmart was down 11% the day they reported results. Why? Well, they say two things. One, they're facing greater inflation in their cost structure. And secondly, they're noticing that their clients are shifting from higher ticket things, higher value purchases, to lower or substitute value purchases. So they're not making as much of a profit as they had been doing. So this was the reason for the dramatic, quite substantial, meaningful price falls. Now, let me just say, the Treasury bonds, they went up in price. This is somewhat of a rarity. The 10-year Treasury closed last Friday at 2.78%. That was down 15 basis points for the week. And don't forget, the previous week, it was down 19 basis points. So it's down a total of 34 basis points. It was up above 3%. Now it's below 3%. And even the 30-year Treasury closed at Friday at 2.99%. Both of these mean that was down 11 basis points for the week, down 13 basis points for the previous week. Both of these are indicative of investors' concerns over a slowing economy. That's why they're buying bonds. Last week for the big five, this is Apple, this is Microsoft, this is Amazon, this is Facebook, and this is Google. All five of these stocks were down, and they were big leaders last year on the way up. Now you have Apple down 22%, 22.5%. You have Microsoft down 24.9%. Amazon is down a full 35%. Facebook is down over 40%, and Google, which is now called Alphabet, down 24.8%. So your big leaders have been under some pressure. It's our thinking right now that you're likely to see somewhat of a bounce. You have all this bearishness. You have interest rates that have come down. They're no longer the competition for stocks that they were. What would cause us? We need a catalyst. The market needs a catalyst. One catalyst could be something where China begins to open up its economy. They've had these big restrictions going on. Secondly, would be some development, a positive development in the Russia-Ukraine conflict. And of course, the Fed saying that we're watching things carefully and we're not going to let things get out of hand. The S&P closed last week at 3,900. There are some people who are saying that it might sell down. It's currently 16.6 times earnings. In January, it was about 25, 26 times earnings. Now it's 16 times earnings. There are some people who say it could go to 14 times earnings. If you put 14 times earnings, not times $225 a share, but $215 a share, that comes out to about 3,100, which would be a significant drop from here. That's not our base case right now. We are watching carefully along with you. We thank you very much for listening today and look forward to speaking with you next week.